Good morning, everyone. I think it's 9 o'clock. My screen should have a little print up there showing you all the URLs. We'll dive right into it. This shows you the magnitude of overbidding. This is single family homes in the different micro market areas. The redder the color, the hotter, the more the overbidding, the bluer the color, the less. And this is the magnitude. So this is how much they're overbidding. This next slide is similar, but it's the frequency. So how common is overbidding? The more common it is, the redder the color, the blue color, it's overbidding is not very common. In the Atherton area, you can see there's only 25% of the sellers are getting overbids. But if you go up to Milpitas, it's basically 80%. So that's a pretty dramatic difference in a pretty short distance. And I believe it's based on COVID, what people need to make their lives work. And now we're moving on to unsold inventory. Unsold inventory is the key indicator. It's the supply-demand balance. Here, the redder the color, the hotter the marketplace is, or the seller's marketplace. The whiter the color, the more balanced the marketplace is. If we've had any buyer marketplaces, that would be in blue. This is just showing the 22 different micro market areas of unsold inventory. You can see that I have a data error that I will try to correct for next week. But right here where you have this dive down and up, that's one bad data point. So I'm coming down here to 0. I'm coming down to some other random numbers. So you have to ignore this point and basically jump right across of it. But you can see the last several days have been consistent. What you're looking for here, at least what I'm looking for, is if a lot of the lines are going up, that's increasing days of unsold inventory, which is a slowing down of the marketplace. If the lines are mostly going down, that's an increasing of the speed of the marketplace. Now what we're looking at is the gold standard. This is the 5-year median. The 5 years I selected were 2015 through 19, which were all good years. So if you're on the yellow line, you're having a good year. And the two purple lines, this is the announcement of COVID. This purple line is distinction between 2021 data from this point backwards, and the next data point going to the right is going to be 2020 data. So you can see that we're very close this year to being right on the normal. We had a little bip up last year next week, which was the Super Bowl. And last year, the 49ers were in the Super Bowl. I don't expect that blip to be nearly as much this year. So I expect it to pretty much stay right down here. This discontinuity is because of shelter in place. So at this point in time, if you wanted a projection, I would say pretty much follow the yellow brick road, follow the gold standard. I think that's where we can expect it to pretty much be. Here we're looking at, there's 3 lines, but there's 2 components. The first one is supply. We're going to look at that 2 different ways. One is the total available inventory. This is the total amount of houses that are on the marketplace right now for sale. Basically, what is the volume of the reservoir? You can see that right now we're basically somewhere just over 40%, maybe 42%, which means there is more properties for people to choose from. And you might think, wow, that's completely, not what I'm expecting, because we're in a hot marketplace. You have to look at where that inventory is. Is it in condos and townhouses? Is it in Menlo Park and Atherton? Because in the Milpitas area, in the Santa Teresa areas, in the affordable areas, there just is no single family inventory available. So you have to compare apples and apples. But globally, this is the macro data. And then the next one is the new inventory just coming on the market, which is the gray line. So you can see that we were at 130%, we were about 145%, and now we're about 120% last week, and we're also at 120% this week. So we're 4 weeks into it. All 4 weeks have been above normal, because the gold standard is right here at 100%, because I'm comparing it to that. This is a ratio. But what's important is what's happening to the other side of the equation, what's happening with offers. And you can see offers are keeping right up there, 160%, 140%, 138%, probably 138%. So the number of new offers are actually higher than the number of new listings, which keeps the market in the hot condition that we're in. In fact, I think I looked at this, and inventory is down just a few units from last week at a time of the year when inventory should be growing. So then basically, as new inventory is coming on the marketplace, at least so far, there's been enough buyers to buy up that new inventory that's coming on the marketplace. So now we're looking at the number of active listings without an offer. And that's a very important distinction, in my opinion. A lot of the people that will quote numbers will be quoting active inventory. And that includes things that are in escrow with backup offers being solicited. I don't count those. And I think that's really right this time of the year is when that makes a difference, because you have almost no inventory at the end of the year. You have more inventory coming on the marketplace, but it's selling. So you have a huge increase in the number of offers that are in escrow, but the listing agent wants people to continue to show it. So those people are showing that number increasing, where the inventory that's available for a buyer that wants to buy today, that doesn't have to kick out a previous buyer, is actually down a few units. And that's why I'm pointed out, because I'm one of the few people that look at simply active inventory, no offers accepted. So differences, but as long as you're consistent, you should be able to make some heads or tails out of it. So you'd expect to be right here on the gold line. And right now you can see we're quite a bit above. So the question again is, at 1,500 homes, where is that 1,500? It is not in single family homes in Santa Clara County. This is macro data. So that's why it's important to look at and understand all the different stuff. So here's the number of new listings. And you can see for the first 3 weeks, we had quite a few actually all 4 weeks, we had quite a bit of extra inventory coming on the marketplace compared to what you're supposed to be having. This is last year. So last year we were more normal. We don't know what's going to happen until we get the next week's data point. At this point, I think there's a discontinuity because of shelter in place. People are realizing that their needs have changed, their work environment has changed. So there's a lot of people that are trying to adjust their housing situation for our new reality, which is a little surprising because you would think that the new reality is short-lived, but if it's intolerable, you have to address it even if it's short-lived. So people are accelerating their plans of moving. So in the future, once we're through this, we may actually see a reduction in volume because the people that would be selling and buying in a year from now are trying to do it currently. Here's the number of new offers. And again, the number of new offers is significantly, and it's the vertical difference, because the horizontal difference here is pretty close, but you have to compare week 1 and week 2, week 3 and week 4. So the vertical separation is pretty significant. So right now we're here at 410 listings maybe, and normally you may be at 310. So it's almost 25% more offers are being accepted. I think I did the math, and I think it was actually 30%, but it looks closer to 25% more offers are happening right now every week than you expect to have happening. This is the frequency of overbidding. And this is something that, I used to think this was a great benchmark and, very valuable, but the more I'm looking at it in detail, the more I'm wondering. Look at the drop between last week where we were at 60% to this week where we're down to 48%. I'm just shocked that even though I'm only looking at 1 week at a time, and by 1 week, there's something like 225 properties involved in this, I think. For the pressure the buyers are feeling, I think is pretty much constant from week to week to week. So I would think both the frequency and the magnitude of overbidding would be more constant. And, I've been commenting about the sawtooth over here that sort of caught me by surprise. And it's real. I've gone back and checked the data. This is a fairly major sawtooth that I don't understand, because this is last year's data point. So this is this year's data point. I spent about 15 minutes trying to trace this down because I'm not uncomfortable with it, but I think it's real. So I just don't understand why it fluctuates so much. Here is your micro market areas. Again, this is a bad data point. I'll try to go back and correct that, but I'm not seeing any huge trends up or huge trends down. And you might even say that there's some downward motion here, which I could believe because these are 5 weeks ago when these offers for the most part were negotiated, which was basically in the holiday season. But I wouldn't expect a jump for 1 week. The downward pressure during the holiday doesn't bother me. It's just the 1 week. And then here's the magnitude. So on week number 1, you were, say, 103, maybe 0.3, then at 103 even, then up to 104, and now down to 102. I mean, I just wouldn't expect that kind of sawtooth motion, but you can see that it was fairly constant here because you were growing. But once we started leveling off, you can start seeing the sawtooth. And, here was a pretty significant sawtooth. So I'm surprised, and what I may do is try to find out if there's a duration pattern on that sawtooth, and instead of reporting 1 week data, I might start reporting 2 week data or 3 week data to try to smooth it out so you can see the data better. The same bad data point. Again, this is all the different micro market areas. You can see this one gold line is shooting up. I could open up my Excel and tell you what micro market area it is, but it's hard to tell from all the different lines that are on these graphs. Here's the overbidding. And if you remember from last week, this red line was basically coming up here by itself. Now it's in the middle of the pack and towards the bottom of the pack. So there has been a dramatic shift from just last week, and I don't think it's real. I think it's statistical fluctuation because the market fundamentals haven't changed. I do want to point out again that I am comparing these outlining dots to the worst December ever, the best December ever, and the worst December ever. It should be January. I just haven't had the opportunity to get to that point yet. Same data set, just not as many data points. You can see the red lines down here where last week, I think it was the top line, if I remember correctly. So again, I'm just a little concerned on how much it's moving around. Now we're looking at instead of just looking at 1 week, we're looking at the total month of January. And again, the red line is going to be January 2021, and I'm comparing it to December, which is not an apples and apples comparison, I know, but that's what I have available. I don't feel that bad about it because December closes are November contracts, which are basically influenced by the holidays. January closings are December's. So I think it's reasonably okay. It's not a habit I want to get involved in. It's just where I'm at right at the moment. This pattern is really bizarre. You can see, look at the shape of all the lines. And then down here, you're getting a sort of a stair step, which is a red flag to me. And then you have this huge stair step, which says, basically got one thing happening when people are at or below the asking price. And then once you get above asking price, people are doing a fairly major jump, which we've never seen before. So again, that questions my data, which is why I looked at it, but I don't see anything. And then it flattens out at the top end. I mean, it's just not behaving the way I'd expect it to be. So I'm fully at this moment, even though I can't find it now under the time pressure, I expect to report, oh, I found the error next week, but I have to report the data that I have this week. So now here is the last 12 years. And again, it's comparing December to January, which is not fair. But again, it's the same data. So of course we have the same shape. I'm just getting rid of the older data set. So right now, when you look at this line, you're having essentially the worst January based on December's data. I think there's something wrong. Here's the sale price is that I track, which is the 10, 50, and 90 percentile. The 50 percentile is also called the median, which is what most people follow. The redder the area, the more expensive the median price is, and the coloring is done on the median price. The bluer the color, the cheaper the prices are. So you can see the exact range here. It is amazing to me on how close all this area in San Mateo County is. And even with Cupertino, there's not that much difference when you come over here and look at it. The median price 1.83 million, 1.9. So there's only $70,000 difference. Cupertino Sunnyvale's at 2.0 million, and Bay Cities is at 1.9 million. So basically in $200,000 and $200,000 and 10% of a price change, you have a very significant number of geographical areas that are all in that same price point area. Here's the individual data points that you can come back and look at. This particular page 1 is single family homes in Santa Clara County. Page 2 is San Mateo County single family homes. And page 3 is condo and townhouses in both areas. And that's it. And I'm open for questions before I go into the details. All right, I will proceed. This graph we've shown, there's not much there. It's a nice piece of artwork. This is what I'm really trying to find. And this is the sale price to list price ratio. And this may be why I'm having so much jumping. And this data I know is accurate, but it's surprising on how much fluctuation there is from week to week. And this is when I use 1 week data. So I will probably come back and use something like this, pick the number of weeks, increment it from 2 weeks to 3 weeks to 4 weeks to 5 weeks, and see at what point I get a smooth line, because you don't want to have data going from here to there in 1 week, because then you don't know if the market's crashing or if it's just your statistical fluctuation. It's clear to me, there's a few things I've learned by doing this exercise. This is the median price. So like through here, you're spending a lot of time right at the 100 percentile. So you don't want to use the 50 percentile for looking at your sale price to list price distribution. And I'm leaning towards these three, which I think are 90%, 85%, and 80, but I think the yellow is actually 75. So it's probably 90, 80, and 75, something like that. But I'll work on that offline and come back with the results. This is December's data, just showing what's happening. It's 5 weeks data. It starts on the first of the month and goes. And what's interesting is the sale price. You come over here and it's in the red here. Your list price to sale price ratio, 103%, 66% are getting overbid. Again, this is basically for the month of December, and I'm reporting it on January the 5th. And I'm just throwing that up to give you some track record. We're back to the weekly data. We have 11 metrics. We have 5 slides. We're going to look at one slide in each one. The first one is the key days of unsold inventory. This is countywide single family homes, and you can see the impact of the holidays with the market slowing down. And notice how the condos don't really impact it. That is one thing I have noticed for a long period of time. The condo market is not as volatile as the single family marketplace is. So this is the slowing going into the holidays. If you look back here last year you had the slowing and then you turned around and accelerated. We had a major slowing for COVID. We accelerated out of COVID and we've been in a hard marketplace ever since. This is looking at the frequency of overbidding, how common is overbidding. And you can see the condo market's dropping down a little bit for the holidays. San Mateo County has been dropping down for a longer period of time because they do have more inventory, which is why you're seeing the Redwood City area have a higher days unsold inventory, rest red in that color on the map. And here we are in Santa Clara County single family home, and it's tooting along right at 65, 68% of the sellers are getting more than their asking price. This is the magnitude of overbidding. Santa Clara County, I would say, sort of started to plateau here, but now turned around and went up. San Mateo County dipped down, and it's hard to tell, but it's clearly flat. And Santa Clara County has pulled away from San Mateo, and the condo market is basically right around 100%. So they're getting what they're asking, but they're not really getting any overbidding. And that's because people want the extra space, the extra privacy. Median days on market, you can see that the condo market actually skyrocketed here, which I really don't understand. This drop off, I do understand it. It's not that the market's improving. You'll notice that all 3 of them are dropping off. And basically what happens is at the end of the year, you have no inventory. So as you have new inventory come on the market, everything has 0 days on the marketplace. At the end, we'll go back and look at the table and we'll see there's a huge difference between the average and median days on the marketplace on what's on the market compared to what's selling. So what you have is 2 different marketplaces, one of what's coming on the marketplace and selling right away, and another market is coming on the market and sitting. This is the current available inventory. You can see the dip down. This I show all the micro market areas because they're separated a bit, so you can see the data down here in the lower right hand corner. All of the components come crashing down. So that's the slowing down of the holiday. It was a little later than normal. This is basically right around the middle of November. Normally there's a major slowdown right after Halloween as people are starting to get ready for Thanksgiving. With COVID, holidays are a less impact on the real estate market. Holidays always negatively impact real estate except for Valentine's Day and Mother's Day, which do have a positive impact. So the fact that, we have COVID has helped us out from that a little bit. So here you're looking at the number of offers the past 5 weeks. You can see it's come down. You can see it's just starting to go up. If you think about it for a second, you get out through the holidays, then you have to get the inventory on the marketplace, and then the buyers come out of the woodwork. So it's just about now when the number of buyers starts going up. And you can see that last year where you started January the 4th, and then you were into it for several weeks, but all of a sudden, boom, the number of offers started to come up. We're basically at that same point right now, and we're right about the point where, this current week, so next Saturday when I'm reporting on next week's data, I expect that these sales are going to start going up pretty significantly. Here's the closed transactions, same pattern as the offers, but delayed by the 5 weeks. So it's going to continue to be plummeting downwards for a while. Here's the 10 percentile pricing. This is nice because you can see if the bottom of the market price, the lowest portion in every geographical area, is performing the same or differently than any other area. The red line is what you probably want to focus on. It's the single biggest micro market area, which is all the single family homes in Santa Clara County. And frankly, it's pretty flat. Yes, there has been appreciation, so it's not flat, but it's not going up, it's not going down. Move on to the median price. Again, you can see the red line right through here. It's fairly flat. If you come over here, it's significantly higher than it was last year, but we're not seeing anything like this happening on the county level. This happens in smaller micro market areas, and this one is one of the more expensive ones. So this is probably Menlo Park would be my first guess. So San Mateo expensive. Actually, that looks like this one, which doesn't make a whole lot of sense. So I think the coloring isn't quite matched, because the Menlo Park area is going to be the most expensive area, and this would be the most expensive area. I'd expect this one here to be Palo Alto, Los Altos, which is over here, and that looks like a pretty good match. Here's the county data. It's just dropped off the others, all the micro market area, and here's the top 90 percentile. The 90 percentile is going to have more fluctuation, because when you're in the top, the difference between the 90 percentile home and the 95 percentile home is a lot more than the difference between the 50 and the 55th percentile. So it just tends to fluctuate more based on what's happening. Here's the data overall. And again, you can see that I'm consistently with that bad data point throughout. So I'll find out what date that is and try to correct it. Duration of escrow, really no data here. We're basically at 30 days. I think people are getting used to that. Frankly, I write offers at 35 days just so that you don't have to worry about holidays and weekends and all that kind of stuff. What we're going to do now is look at days of unsold inventory, and I'm increasing this, and I don't know how far back to go. So I'm leaving it this on December the 19th, which I now think is actually 6 or 7 weeks back. And the concept is to look at the color change as we go through. And at the very end, I'm going to come back to this slide so that you go all the way through current date and then jump back. So here we start in the middle of December this is December 19th, basically the middle of December. It's showing you the red color, the redder the color, the hotter the market. We're going to step forward and look at week after week after week. And what you want to do is pick your favorite area, just in general, look at the concept, and then see how the color changes as you move forward. So here is the 26th of December, 1 week later. You can see it's changed a little bit in the intensity of color. It's got a little lighter for the most areas on January the 2nd. Moving on to January the 9th is lighter. Now you actually have some blue coming up. You have some white coming on there in Palo Alto. That's the 16th of January. Now look at it here on the 23rd of January. Your coast is fairly white. It's got a lot more pale up on the San Mateo County area. South County has gone paler. And then we have current data. So current data looks like it's a little hotter than yet last week's data. And then just for comparison, we'll go from here back to the 19th of December in one jump.
So, okay, yeah, so then I can see. I think the market slowed down a little bit.
The market slowed down for the holidays, right. And that's what happens every year. And this just lets you see it visually, so you can see it happens, and it happens at different amounts in different areas. So you can't summarize what's happening in the marketplace accurately in 1 or 2 data points, because what's happening in one geographical area is different than what's happening in a different geographical area. What's happening in single family homes is different than what's happening in condos and townhouses.
But now you're only looking at the single family house.
I'm only looking at single family because the single family is about 75% of the transactions last time I looked at it, and almost about 85% of the dollar volume. So that will be changing over time, and it also gets harder to determine what is a condo, what's a townhouse, what's a patio home, where do you put them. So you can slice the data so much, and I don't want to go too far. Right now is a key time not to have too much of the macro data, because when you look at the macro data, you're combining the condo market, which is really slowing things down, and the single family market that's on fire, which is why I did add back in the single family graph, was because I was realizing that was happening. So yeah, I was originally, the intent of these seminars was originally to watch what's happening to the global marketplace, because myself and probably 99% of the people thought with the pandemic, we would be having a pretty down real estate market. And in fact, the opposite has happened. We're having probably the hottest marketplace I've seen in my 40-year career.
Oh, okay, yeah. So this is a good one now. Good map. I
All
can
right.
see.
And how far back do you think you want to go? The 19th of December, it doesn't take that long to go through it. I have the data. Should I go back 2 months, 3 months back? What's reasonable?
I think 1 month, 1 month or 1.5 months.
All right.
Yeah, that should be. Yeah,
All
that
right.
should be okay.
And just to close out, here are the URLs. You can get to future Zoom presentations by using TinyURL. That's TinyURL RE market graphs is my root URL. Then you add the year to get to the live presentations, to get to the handout, which is out there. And I try to get it out about 15 minutes before the 9 o'clock start time. You add the word handout and the 8-digit year, month, date code. The archives are just at the base URL. And to get to the specific episode, you add the date code, and it takes me till about 3 o'clock more or less to get it up there on YouTube. With that, I'll pause looking for any other questions and see everybody next week. Any questions?
Okay.